If you're thinking about taking out a student loan or already got one that you're paying back, chances are a decent chunk of each monthly payment you make will end up going towards interest. Interest is calculated as a percentage of the amount you've borrowed when a lender gives you money, and it's basically like a regular fee you've got to pay back for the privilege of getting to use a loan provider's money. Interest payments can be pretty frustrating, but there are some ways that you can bring the interest down on your repayment plan, and one of the easiest ways to reduce the cost of your student loan interest is by using the student loan interest deduction. In this video, I'll go over everything you need to know about the student loan interest deduction, eligibility criteria, how much this tax deduction is worth, and how you can claim it. Let's get started. Student loan interest is a tax deduction thanks to something called the student loan interest deduction. The student loan interest deduction lets borrowers deduct all or part of the interest they pay on their federal student loans and private student loans when they file and submit their annual federal tax return to the IRS. You can claim the student loan interest deduction even if you use the standard deduction, but as you might have guessed, there are a few important rules around who is eligible, which kinds of loans qualify, and how much you're allowed to claim as a tax deduction. The student loan interest deduction is an above-the-line exclusion from income that you can use when filing your annual taxes with the IRS. An above-the-line exclusion from income is also sometimes called an adjustment to income, and it lowers the adjusted gross income on your federal income tax return. As a result, it also reduces your taxable income for the year. All you gotta do to claim student loan interest deduction is add the total amount of eligible student loan interest on IRS Form 1040. You should be able to receive this tax deduction for any interest that you paid on qualified college loans during the tax year up to a total of $2,500. If you paid less than $2,500 in student loan interest, your student loan interest tax deduction is based on the total amount you ended up paying. For example, if you only paid $1,500 in interest on your student loan repayments for a given tax year, your deduction is $1,500. While the student loan interest deduction is a common tax deduction that applies to many borrowers, it's important to remember that not all loans are eligible. Eligible college loans include all federal student loans and most private student loans. Interest paid on federal student loans made through the Federal Direct Loan Program and the Federal Family Education Loan Program count toward the student loan interest deduction. Another point to bear in mind is that the student loan interest deduction is available to both student loan borrowers and parent loan borrowers. On the other hand, loans from someone else who is related to you or loans from a retirement plan aren't eligible for the student loan interest deduction. The loan must be a student loan borrowed for you, your spouse, or your dependent. To qualify for the student loan interest deduction, the loan that you've taken out must also have been used only to pay for qualified higher education expenses. Examples of a qualified higher education expense will typically include things like college tuition fees, housing and meal plans, textbooks, supplies and equipment, and transportation to and from school. Mixed-use loans such as credit card debt aren't generally eligible for this tax deduction. The only exception to this rule is when the loan you've taken out is used only to pay qualified education expenses and absolutely nothing else. The amount of qualified educational expenses must be reduced by the amount of qualified expenses used to justify other education tax benefits. IRS rules prohibit double dipping. Double dipping happens when a tax benefit is applied to decrease your tax liability using two or more tax deductions and credits. In the context of student loans, double dipping would be when you use the same expense to justify two different education tax benefits. For example, the same qualified expenses cannot be used for the student loan interest deduction, the American Opportunity Tax Credit, and a tax-free distribution from a 529 plan. The IRS won't allow this, so when in doubt, use each expense to justify only one tax benefit. The student loan interest deduction is a pretty inclusive IRS deduction. That being said, not every single borrower qualifies, so it's important to double check that you qualify for the student loan tax deduction before it's applied. You're going to need to meet certain eligibility requirements to claim the student loan interest deduction. Here's the criteria. You'll need to be legally on the hook to pay the interest on a qualified student loan. Borrowers and co-signers are legally bound to pay back student debt. A parent who voluntarily makes a student loan payment on their child's loans can't deduct the interest if they aren't legally bound to pay the interest. You must not be claimable on anyone else's tax return. The student borrower may be able to claim the deduction based on the amounts paid by the parents, but only if the student cannot be claimed as a dependent on the parent's tax return or on anyone else's tax return. If the parents could claim the student as a dependent but choose not to, the student still isn't eligible to claim the student loan interest deduction. Your tax filing status must be single, married filing jointly, head of household, or qualifying widower. Taxpayers who file their federal income tax returns as married filing separately aren't eligible. The student borrower will also need to satisfy certain eligibility requirements to claim the tax deduction. The student must have been enrolled on at least a half-time basis. If the student is enrolled on less than a half-time basis, which is pretty common in continuing education programs, the student loans aren't eligible for the student loan interest deduction. The student must be enrolled in a program leading to a degree or certificate at an eligible higher educational institution. Eligible educational institutions are limited to accredited post-secondary institutions that are eligible for Title IV federal student aid. There is an income limit for the student loan interest deduction, so you might be ineligible if you have too high of an income. The income phase-outs are based on the taxpayer's filing status and modified adjusted gross income. The amount of the student loan interest deduction is reduced proportionately within the income phase-outs and eliminated entirely when income exceeds the upper end of the income phase-outs. Income phase-outs start at $70,000 for single people, head of households, and widowers. If you're married filing jointly, income phase-outs start at $140,000. So, how much will a student loan interest deduction actually save you? Well, it's important to note this is an above-the-line deduction, not a tax credit, so it only helps you reduce your taxable income. For example, say you have $60,000 in taxable income last year and paid $2,500 in student loan interest. Since your income is below the income phase-outs, the student loan interest deduction is not reduced. Your taxable income will become $57,500. This then lowers your tax liability. To understand how much that will ultimately save you on your tax bill, multiply the amount of student loan interest you're eligible to deduct by your tax bracket. If your income is $60,000, you're in the 22% tax bracket. If you paid $1,000 in student loan interest, which is about the average deduction, the student loan interest deduction will save you about $220. The maximum anyone might save is $550. Luckily, claiming a student loan interest deduction is relatively easy since you don't need to itemize your taxes to claim the deduction. If you paid more than $600 in student loan interest to a single lender, you should automatically be sent a copy of IRS Form 1098-E from your student loan provider. This form states how much you paid in interest on a given qualified education loan. But if you don't get sent a 1098-E form from your lender, don't panic. Typically, all you gotta do is call them and ask for confirmation of the total amount that you paid in student loan interest for that tax year. You may also be able to access this information by logging into your account on the lender's website. Although your lender should be able to provide you with the correct amount of interest paid, the IRS asks borrowers in the instructions for their 1098-E not to contact their lenders for explanations of the requirements and how to make an allowable deduction for interest paid. Instead, that information is all available on the IRS website, but fortunately for you, it's actually super simple to claim. Once you've got the correct amount, all you need to do is enter that number on line 20 on Schedule 1 of IRS Form 1040 before submitting. submitting. This will need to go where it says Student Loan Interest Deduction. And that's it for this video. By taking advantage of the student loan interest deduction, you can reduce these costs and put a little bit of money back into your pocket every year. You can check out the full blog on this topic with even more information on our website. We'll link to it in the description. Subscribe to this channel for more videos about student loans and saving for college, and we'll see you in the next one.